Hello everybody, welcome to this week's edition of Northwest Quadrant Wealth Management E-News. Thanks for joining us. So over the last year, Josh and I have been talking quite a bit with you and amongst ourselves about how this market reminds us quite a bit of the late 90s market, the tech telecom media bubble that we saw then, where a lot of companies were going public, everybody was piling money into technology, very similar to the markets we're seeing today. And then we know in the year 2000, the market rolled over and sold off 50% over the next 2 years, with the NASDAQ, which is the tech-heavy index, sold off 80%. But if you go back to that period and you had a properly diversified portfolio of large, mid, small, international, you actually did quite well during that period relative to what the overall market did. And so that's how we think about our portfolios that we're building for you and for ourselves. We want to build durable portfolios that last throughout any market. Not a portfolio that's just tied to the upside of a crazy market like this one. And so last week we saw a very interesting trading day on Monday, where we had the situation in China where there was a disruption with AI, and it looked like maybe Nvidia maybe wasn't going to be worth quite what investors thought it would be worth. And we saw the NASDAQ sell off 3% on Monday, but the Dow was up over 1% on the same day. It was very similar to what we saw in the late 90s. And so the Dow is full of boring, old line businesses. The NASDAQ's full of technology. And so we saw this huge rotation out of technology stocks into these so-called boring blue chip names. That since has reversed, but we think that when the market does eventually roll over, that it's going to pay to own some of these parts of the market that have been left for dead and that are quite undervalued relative to technology stocks. We don't know when that's going to happen. We just know that we're building portfolios for you that are going to withstand those big market sell-offs better than if you had a portfolio totally tied to technology stocks.
Sort of lost in the noise this week also, there was a Fed meeting on Wednesday, and of course the Federal Reserve left interest rates unchanged. The more important thing that the market really focused on was some of the language that got removed. It appears that market expectations into 2025 are adjusting to the reality that rates have likely found their floor, or at least in the near term they have, and I think you'll see those expectations continue to reduce anticipated interest rate cuts out of projections as the data continues to come over the months to come. But remember that Monday sell-off. Interestingly, it's important to treat any news out of China with a degree of skepticism. They have a habit of exaggerated claims, and of course it's in their best interest to undermine the dominant narrative. And of course they're replicating American technology to the best extent they can. But that noise was lost amidst this AI frenzy. We kind of laughed earlier this morning when you saw the retail flows into these speculative names were at their highest level ever. There's obviously still a lot of excess liquidity and froth in the system if retail investors are willing to pour literally $1 billion over the course of a day into a single individual retail name, and namely Nvidia. But interest rates and earnings are still ultimately what drives stocks. Earnings season's been really good, but when you look forward through 2025 and you think that there's definitely going to be a digestion phase where all of this AI-related spend has to have a return on investment, otherwise it's not worth much. And I think that will be the focus of markets going into later in the year. But interest rates seem to have found a near to medium-term floor.
So we're at that stage in market cycles where a lot of you, Josh and I, are getting phone calls and emails and in meetings where a lot of people want to take a lot more risk. And that to us is sort of a bell for maybe a market top. And so when retail investors they feel like the future is known, that the Fed can bail us out of anything, that's when we start to get really nervous about markets, when participants in markets, namely retail investors and a lot of our clients, want to take a bunch more risk. That's when we really start to get nervous, and that's what's happening right now, similar to what we saw in the late 90s. So we're urging caution. We're happy with where our investment portfolios are right now. But what we're trying to say is you should expect some volatility, and that means to the downside in 2025. It doesn't mean we're going to have an awful year. We just know that a lot of people are on one side of the boat right now, and that's the bullish side of the boat. And so that starts to make us nervous. So as always, if you have questions about your situation or your account, give us a call at the office, 800-743-0988, and we'll see you here back in a couple weeks.